Hello. Hello.
Yes, sir.
Yeah, Bharat. So the first particular, like this is done. They have given some example. Consider a forward contract to buy 100 shares of Acme at $30 per share 3 months from now. Okay. So how many shares, is supposed to be bought? 100 shares of Acme company. And what is the price fixed? $30 per share. And that to 3 months from now. So Acme shares are underlying asset in this for the forward contract. $30 is the forward price in the contract. Okay. The date of the future transaction when shares will be exchanged for cash is referred to as settlement date, maturity date of the forward contract. 100 shares is the contract size. The forward price is set so that the forward contract has zero value to both parties at contract initiation. Of course, neither party pays at the initiation of the contract. Okay. So we examine three outcomes for price of Acme shares at settlement. Spot price. What is the spot price today? $30. This is equal to forward price of $30, right? Hello. That is on today's date. So forward contract to buy 100 shares of Acme at $30 per share 3 months from now. From today to 3 months, they have made a contract to buy shares of Acme company for $30. What is this saying? Spot price or market price of the underlying is $30 equal to forward price of $30. Is it right? Hello?
Yes, sir.
So spot price or market price of the underlying is 30 equal to forward price of 30. If these two are okay, that means if there is if the spot price equal to 30 forward price on that day when you are going to fulfill this contract or on the maturity date, the forward price at which you fixed to buy that stock is $30, and on that the market price or the spot price is $30. Are you going to make any profit or loss out of it? Nothing, right?
Nothing.
Now, there is no transaction cost as of now. So neither party has profit or loss on forward contract. Ignoring transaction cost, the party selling Acme shares could buy them back at 30 per share, and party buying the shares could sell them at 30. Okay. But if it goes 40, the market price or spot price goes 40. So you can buy at 30, sell at 40, right? And make a profit of $10 into 100 shares, $1,000. Correct? Is it
Yes.
right? And vice versa. If the forward price is 30 and the spot price is 20, making a loss of $10. Okay, that's done. And the spot price of Acme shares is $25 on settlement, less than the forward price of 30. So what will happen? Party buying 100 Acme shares for 3,000 at settlement and then sell those at 2,500, loss of 500. Okay. So the party must deliver the Acme shares, deliver shares with market value this much and receives this much. So what is that they're saying? If the spot price is 25 and the forward price is 30, you are making a loss of how much?
$500.
Okay, so your loss is whose gain? Other party's gain, right?
Seller. Other parties.
Yeah, that's right. So the party that must deliver the Acme shares delivers shares with market value of this much and receives this much. For them it's a gain, for you it's a loss, if for
Yeah.
investors. This is done. In practice, a forward contract may be a deliverable contract. In our forward contract example, this means that payment and the shares must be exchanged at the settlement date. That means the stocks have to be taken and the money have to be received. This is deliverable, but I already explained about cash settlement. That is typical of futures. Correct or wrong?
Yes, sir.
So in our example above, with the share price of 25, cash settlement would require the buyer of Acme shares to pay 500 to the seller. So in cash settlement, what happens? Delivery is not happening. One party A and B two are trading. One party's losses, other party's gain. Okay. Just a second. Yeah. So you understood, right, Bhargav? In this, from A's account, the money will be deducted and will be credited to B's account. That is cash settlement, right?
Yes, sir.
We discussed that in the case of futures. And we can view a derivatives contract as a way to transfer risk from one party to another party. Consider a situation where the share seller, that means the broker or whoever is, in the forward contract owns 100 shares of Acme. She has existing risk because the future price of Acme shares is uncertain. The share price 3 months from now is random variable. If she enters the forward contract from our example, she will receive $3,000 for her shares at the settlement, regardless of their market price. So it's kind of hedging or not? It's kind of minimizing your risk or not by fixing a price. Hello.
Yes, sir.
It is kind of, it is kind of what?
Hedging.
Hedging. We have just minimized our risk because we have fixed the price today itself. Okay, so these are all the points. All I have explained you. Yeah, underlying assets and variables. Underlying for a derivative is most often a stock or bond price, but not only restricted to this. There are many things which can be considered. The level of a stock or bond index or an interest rate. Here we give examples of different underlying assets and variables. So we take underlying assets like stock or bond. We take variables like interest rates, okay, which is mentioned here for derivative contracts. That means if I tell you about forward rate, what is happening in forward rate, Bhargav? In forward rate, you are fixing the
Interest rate.
interest rate. That's what. It is not only the underlying, it is also the uh, derivative contracts are also made for variables. This is not fixed. This is variable. Now, we present more details about derivatives based on those underlying assets in subsequent readings. A bond, for example, a forward contract on a 30-year US Treasury bond or other specific bond. Risk involved is the uncertainty about the future bond prices. Everyone knows this. You can also make contracts to buy index stocks, okay? And you can also make contracts to buy currency, foreign currency. In all this, you are fixing the price today itself so that the risk is minimized. You can also fix rates for taking loans in the future or selling your bond in the future or buying or kind of buying bonds at some rate. You can also make contracts with respect to commodities, fix a price today itself so that in the future at that price you buy or sell, you may gain something out of it, some profits, right? And just go for this example, Bhargav. What is this example all about? Please tell.
Sir, it is a form of hedging where if we
I think
find
we have
that the
already discussed about this kind of example yesterday with respect to farmer, right?
yes,
What is credit default swap? It's like an insurance,
okay.
CDS. Credit derivatives include credit default swap, in which one party makes fixed periodic payments to another party, maybe insurance company, which will make a payment only if the underlying credit instrument suffers a loss in value due to default by issuer of the credit instrument. Did you understand? It's like a
Yeah.
credit insurance. And derivatives can also be, seen today in case of like farmers. They can use derivatives for making contracts regarding the produce what they whatever they are producing to sell it in the market to customers. Energy producers like the energy producers like crude oil, etc., they can make it. Tourism companies to sell their tickets, cryptocurrencies, or longevity. And we have already discussed about options, right, Bhargav? Only thing we need to discuss about is swap. So we'll discuss right now. Bhargav, just give me 2 minutes of time. I'm
Yes.
having severe pain. I said, right, I just fell down. So I got some little bit of fever also because of that. Can you give me 5 minutes?
Yes. Yes. Sure.
Yeah, see, like I'm just taking the things. I'm not in a position, but I don't want to skip things. So I'm taking,
It's okay, sir. We'll go slowly.
yeah. So give me 5 minutes of time. I'll be back. Yeah, I'll be
Yes.
calling.
Yes.